Hello everyone, my name is Ryan Hughes. I'm head of active portfolios here at AJ Bell, and I'm delighted to be running through the AJ Bell managed portfolio service for the Q3 2019 update. So today we're going to run through a familiar agenda for those of you that have listened in before. It's an introduction to AJ Bell Investments. We'll quickly run through a review of the third quarter and the major economic and macro events that have been driving market returns. We'll then review the portfolios and what have been the main drivers there, and also just look at any changes we've made over the period and an outlook, hopefully taking no more than about 15 minutes to run through this. So for those of you that are perhaps not so familiar with AJ Bell Investments, we were launched in 2016 and have been ticking over quite nicely and are now running over 350 million in our investment solutions. A combination of both active and passive, both in the MPS side for growth and income. We have the recently launched Pactive portfolios for those of you that would like a blend between passive and active. We have some income funds as well that were launched earlier this year. And our most recent product that was launched is our retirement portfolio solution that looks to provide you with a drawdown and income solution for your clients that are in retirement. And we'd be delighted to talk to you in more detail about those if you would be interested. Let's get straight into what's gone on over the quarter. Well, it's been another pretty positive quarter for markets, but what we have seen is perhaps a little bit more dispersion than we've seen before. Equity markets were broadly strong, with the MSCI World up nearly 4% in sterling terms. And I should say all of the data here is in sterling terms, and that's important for a little reason we'll look at in a minute. But actually, we have seen that dispersion, with Japan performing very strongly, with performance of nearly 6.5% over the quarter. But actually, Asia and emerging markets, so similar region, but actually has been very different performance, delivering a negative return over the period. Fixed interest was also very strong, and we'll look at that in more detail in just a little while. And US equities again strong. So we're looking at some pretty strong year-to-date performance across the major asset classes now. Q1 and Q2 were both positive, and Q3 has built on that trend. Let's get into the detail of that. So what we've seen over the quarter is that all asset classes were positive. Very strong growth we've seen in 2019. Can we do any kind of macroeconomic update at the moment without talking about Brexit? Clearly that dominated the UK landscape over the quarter, with a new Prime Minister in Boris Johnson and a toughening of the rhetoric towards the Brexit negotiations. There. Now, at the time of recording this, well, we're still not quite sure what's going to happen come the end of October. But what we have seen is that the currency has been quite worried about the risk of a no-deal Brexit and has weakened over the quarter. And that weakening currency has again been positive for overseas exposure in the portfolios. So that's helped not just overseas equity exposure, but also UK equities that generate a large proportion of their revenue from overseas. And that's been, sterling was particularly weak against the US dollar over the period. And that actually continues a theme that we've seen pretty much throughout 2019 as the Brexit deadline draws ever nearer. In the US, there were some pretty major events over the quarter with some interest rate cuts. We'll look at those in a little bit more detail in just a while. But also what we've seen in the EU and in Japan is talk of more stimulus if required. And that has certainly been positive for the equity market and the bond market, particularly in government bonds. In Europe, where we've seen yields turn even more negative over the period, and so there's been a very strong rally in the bond market, particularly in government bonds, as we've seen. In the UK, that's particularly true, with an increase in risk of that no-deal Brexit, so that pushed yields lower. Again, we'll look at that in just a second. But in the US and Germany, we've also seen those government bonds perform very strongly. As we mentioned on the previous slide, Japan was a standout performer, really on the back of a supportive Bank of Japan, talking more about added stimulus if required, and that gave support to both the equity market and the fixed interest market in Japan. Other parts of Asia and emerging markets, as we saw, were certainly nowhere near as strong and actually fell back in sterling terms. And that's all to do with an increasing risk of a trade war. So Japan is seen in Asia as the safety safety region, the flight to safety in that region. The money moves to Japan out of Asia, and it definitely benefited from that over the quarter as the rhetoric between both China and the US and the trade war picked up as the period progressed through to the end of September. So looking at a little bit more detail in some of these themes I've just mentioned. So here we've got a 1-year chart of the UK 10-year gilt yield. And we've talked about this quite a lot over the various quarterly updates that we've done. And we can see that from the end of June, so on the right-hand side of the chart, nearly all the way over to the right, we've got the end of June to the end of September, and we can see that there's been a big fall again in the 10-year gilt yield from around about 0.7 at the start of the period to about 0.5 at the end of the period. Now, it did actually trade lower than that, and then we saw a big rally very early in September, a very significant rally from about 0.4 right up to 0.75 really over the course of just a couple of weeks. But as the Brexit situation progressed again, then that yield has come right back. And it's really a very clear way that you can see the nervousness and risk-off sentiment for bond investors in the market. And that long-term trend now over the last year, with yields moving from about 1.6 down to 0.5 over just 1 year, just shows how strong the rally in UK government bonds has been over that period. And arguably, potentially, if we keep moving towards a no-deal situation, or let's say we don't get clarity as to what's going to happen in respect of Brexit, then it's difficult to see any real catalyst behind those gilt yields to push them higher there. So something we watch with interest as the market's very quick and clear to express its feeling through the gilt market. Turning to the US, I mentioned a couple of rate cuts in the US. So this is a very long-term chart of US interest rates. And I wanted to show a longer-term picture because, quite frankly, if I'd done a 10-year chart, it would have been pretty dull with rates not moving for the best part of 7 years. But back in 2015, we saw the US Federal Reserve start increasing interest rates for the first time since the financial crisis. And we've had quite a few increases there, which pushed the interest rate right up to over 2%, back up over to 2%. At the start of the year or at the end of last year. And what I think what's really interesting about this chart, not least because it doesn't actually show it, is that if you had listened to this webinar right at the end of 2018, then we were talking about a very clear message from the Federal Reserve that they were likely to continue to keep on increasing interest rates through 2019. And actually the dot plot, as they call it, which gives you an indication as to where voting members think rates will go, was actually estimating 3 interest rate rises through 2019. Fast forward to today, and of course we haven't had those 3 rate rises. We've had 2 interest rate cuts, a real about turn from the Federal Reserve, perhaps indicating some of the fears that they see in the market, in the macroeconomy data. And so these were the first cuts since before the financial crisis. So a really significant event. Now, what's interesting for those of you that follow the tweets of President Trump is that he actually was advocating that rates should be at 0 or below 0. And he thinks that the Fed have made a massive policy error in raising rates so much, and that's really stifled the growth of the US economy there. So we've got the Federal Reserve and the President of the United States, not quite at loggerheads, but having a pretty strong disagreement about economic policy. It's something, again, we will watch with interest to see how this develops. The market's now pricing in further cuts in the US over the rest of this year and into next year. So clearly they are seeing some concerns towards economic growth, which is something that we've mentioned in these webinar updates over the last couple of quarters. Now, wanted to talk a little bit about the trade war between China and the US, and I thought an interesting way of looking at that was to look at the US dollar versus the Chinese renminbi here, and the rate over the last 5 years. And really, some of the big criticisms that the US have been giving towards China is that the Chinese have been letting the currency weaken against the US, which is of course helping the Chinese economy and hindering the US economy. And so we've actually seen rates move through what people saw as the very significant 7 level. And that went through that back in very early August, but actually has gone through that by quite some margin now, and is back up. Well, is actually up towards 7.2. So there's been a really big move here, and this is something that is really at the heart of the trade war and the toughening language that we're seeing from the US, with tariffs being put on Chinese goods, Chinese retaliating, but also talk that the US may even force Chinese companies to delist from the US stock market, and then arguments over, or not even arguments, but an outright ban of the Huawei mobile phone business from operating in the US, as well, with fears over technology theft and listening devices and so on. So we've seen a real toughening of the war of words between the two countries, and also a toughening of the trade tariffs as well. And of course, the US has also very recently introduced some trade tariffs on the EU. So there may be signs that this trade war is broadening out away from just the Chinese versus the US. And again, something we've talked about on various webinars about how this is likely to hamper global growth going forwards. And it looks like that's starting to really come through in the data. So just another macro event just to look at. So here we've got a year-to-date chart of the oil price. And the reason I wanted to show this was really to indicate how Middle Eastern fears have been picking up again. And what we can see very much towards the end of this chart, the right-hand side of this chart, is we can see a large spike in the oil price. And that was to do with the drone bombing of the Saudi Arabian Aramco oil refinery, which has taken a reasonable chunk of that refinery offline, which will have an impact on global supply. And immediately on the back of that, the oil price rallied from $55 a barrel to about $63 a barrel. So a big jump. Now, I think what's interesting is that quite quickly here is that the oil price has actually fallen back down again to below that initial level there. And I think a lot of that is to do with the level of self-sufficiency of the US. And they're not major importers of Middle Eastern oil. In fact, the US has become an exporter of oil, given its oil, the utilization of its oil fields, and so there is a not quite the same reliance on Middle Eastern oil as there has been historically. But it's clear that tension in the Middle East is there, and there's Saudi Arabia, Iran. Conflict as it is, that looks like it's being played out in the Yemen, is clearly something that's at getting the attention of the market, and it's very, very important. I think that the world keeps an eye on this if we see an escalation or indeed an outright war between Saudi Arabia and Iran that spills out further away from the Yemen. So something to be aware of. The oil price will be volatile, I think, around this issue, and if we get any further escalation of bombings or tensions, then the oil price will certainly be something that I think will increase in price quite rapidly, as we saw last month with the bombing. So moving away from the macro and looking at the events that have actually been taking place in the actual portfolios, again, all portfolios perform well over the quarter with a strong backdrop. So this is talking about the active and the passive, and indeed the Pactive growth portfolios. So our allocation to equities was very positive, but also fixed interest was additive to strong returns, as we've just looked at, with those yields falling in government bonds and then subsequently also in corporate bonds and high yield. We mentioned about Japanese equities being the standout performer over the quarter. They're certainly looking, investors there, at potential for further QE to support the market from the Bank of Japan, who have really been underpinning equity buying through their purchase of ETFs in the market for quite some time now. And so they were very strong. UK equities were also positive, certainly helped by sterling weakness that we mentioned there. And again, that was helpful to our overseas equity exposure right around the world, but particularly in the US. It was the sterling dollar rate that moved significantly, as well as sterling yen. wasn't quite so pronounced against the euro, but certainly in dollar terms and in yen terms, that helped the performance of those equities there. And government bonds performing well, as we mentioned a couple of times, with fixed interest. If we actually look under the bonnet of the portfolios, and clearly in this section we don't comment on the actual passive elements of the portfolio, because clearly they're tracking market, and we've effectively covered those when talking about market performance. But when we look at on an active basis, in the US, it was really encouraging to see the JP Morgan US Equity Income Fund performing strongly in absolute terms, and also against the broad S&P 500 index. Effectively a relatively defensive manager performing well, and that defensive theme was also consistent in the UK with our Trojan Income Fund significantly outperforming the market. Again, even though the market was up in absolute terms, it was defensive managers that performed well over the period. And I just wanted to point out Janus Henderson UK Absolute Return. So that is held in place of UK commercial property, where in the active portfolios we have a zero weight on a tactical basis over liquidity fears, which have clearly been very topical over the last quarter. And so we don't own any physical property in the portfolio at all. We own Janus Henderson UK Absolute Return, and that was a positive performer over the period. As ever, in the way that we build the portfolios, there will always be some detractors. We like to get a broad spread of sectors and themes and styles in the portfolio. And it was Man GLG that underperformed again, as its value bias was punished. So they had a very tough overall quarter. But interestingly, when we saw earlier on in the spike in the gilt yield, when it rallied very quickly from 0.4 to 0.7, actually we saw value strategy perform strongly on the back of that, but certainly not enough to make up some of the weakness that we'd seen earlier in the period. We have exposure to short duration UK gilts. Now, given the collapse in the gilt yield, now again, this shorter duration positioning has held back absolute returns. So the short duration gilts have made money, but not as much as if we were long duration. We still believe over the long run that rates have to rise from here, and therefore are comfortable running with this short duration positioning. It's a case of we will lag on an upside if we're wrong, but we should, with this position, outperform on the downside if we're right. And that level of asymmetry in our return profile from this position is something we're very comfortable with. And in Asia, obviously Asia was weak, as we've seen on a broad basis, and the Fidelity Asian Values Investment Trust fell back here on the back of trade war concerns. But I wanted to point it out as a reminder, really, that we are whole of market in the way that we use our investments. So we do own investment trusts in the portfolios. It's something we're a big fan of, the closed-ended structure, and our use of the AJBL platform enables us to use investment trusts in a way that perhaps some other platforms aren't able to, and we see that as a big positive for running our managed portfolio service. Turning to the income side, very strong absolute returns over the quarter, and really building on some strong year-to-date returns as well. The income portfolios have been performing very strongly, as the income style has been very much in favour. Those companies that are generating cash, are able to pay a dividend and grow their dividend, have been well rewarded by the markets this year. And also that's been backed up by strong fixed interest performance, as we've seen. Certainly in emerging market debt, that's performed well. And we have some unhedged exposure to US corporate bonds. And by being unhedged, then the weakening of sterling has been beneficial to that position as well. So certainly helpful over the quarter. Now, over this quarter, global property was actually the standout performer. The previous quarter, it wasn't quite so strong, but global property, again, benefiting from the weakness of sterling. You see a consistent theme in these portfolios. That was a big help, while infrastructure and UK property both outperformed the broader global property market, global equity market. And therefore those alternative exposures with property and infrastructure have really been good diversifiers in the portfolio and have been additive to overall return. Just turning to portfolio activity. Well, actually, over the quarter, we've made no changes to the growth or income portfolios in either the active or the passive strategies. As a reminder, we're long-term investors. We want to get our investment selection correct over the long term, which hopefully enables us to reduce our turnover We don't make changes for the sake of it. We want to be comfortable with our managers and let our long-term asset allocation approach come through and our manager selection come through. And therefore, this is a quarter where we haven't made any changes at all, and we're obviously on top of our managers, reviewing our managers, but are very comfortable with the positions that we have today. So just bringing this short update over the quarter to a close, just looking ahead, really trying to. So we've seen a very strong continuation of performance in 2019. Global equities are now up over 20% year to date in sterling terms, and I don't think there'll be many market participants that, if you talk to them on the 1st of January, would have said that the equity markets would have been so strong this year as we were looking at a slowdown in global growth. But I guess to that point, one of the main drivers of this market has been the fact that central banks have started to enact further stimulus. We've seen those rate cuts in the US. We've seen the fact that central banks in other parts of the world are talking about helping the economy as it slows, and the data is certainly pointing towards slowing global growth. We could certainly see volatility pick up, certainly over the next few weeks as we head towards the Brexit deadline of the 31st of October and beyond. This is, of course, an unknown. I think we're all sick of talking about it, thinking about it, hearing about it, but it is the big event driving currency returns, fixed interest returns in the UK, and we can't ignore it, but we certainly anticipate that volatility picks up over the next few weeks. And more broadly, and I've talked about this point over the last couple of updates, is we continue to see a conflict between what fixed interest investors are saying to us about the health of the global economy and equity investors are saying. There is a real challenge here where equity investors have been telling us that things are looking okay and they're banking on the central banks bailing out investors time and time again, whereas the fixed interest investor is telling us that things are getting tough and that with so much of the asset base of fixed interest investments now yielding on a negative basis, that something has to give. We think both can't be right, and the fact that the global economy is slowing is perhaps giving you a little bit of a clue that things are tough out there, and actually that central banks might not be able to give as much stimulus in the QE sense as they have done historically, and that maybe we'll start seeing some real fiscal stimulus as central banks and governments start spending money. In fact, we've seen both in the UK, as we've just finished the party conference season, that both the Conservatives and Labour have both been planning to loosen the purse strings, and that fiscal stimulus may be the way that we get that stimulus going forward. Time will tell, and we'll definitely update you in the next quarterly update on that. So I just want to say thank you very much for listening to this. There's lots of information on our website. The quarterly reports will be out, so you can read more detail of our thoughts there with the fact sheets, with our positioning and our performance. If you have any questions on anything to do with our managed portfolio service, or indeed our funds or our new retirement portfolio service, then do please get in contact with your usual AJ Bell representative, and we would be delighted to talk to you. Thank you very much for listening.